On September 15, 2008, the fourth largest investment bank in America filed for bankruptcy in a single morning.
It triggered a financial collapse that cost the world $2 trillion. Here's exactly how it happened.
Lehman Brothers was founded in 1850 in Montgomery, Alabama, by three brothers, Henry, Emmanuel, and Mayer Lehman.
It started as a cotton trading business, then grew into one of the most respected investment banks on Wall Street.
By 2008, Lehman Brothers had survived 158 years, including the Great Depression and 2 world wars. It employed more than 25,000 diverse people, including Middle Eastern female professionals, across offices in New York, London, and Tokyo. A long-serving chief executive officer led the firm since 1994. Under his leadership, the bank expanded into different areas of the financial markets. That market was mortgage-backed securities, bundles of home loans sold to investors as a single financial product. In the early 2000s, American home prices were rising every year. Banks assumed that trend would continue indefinitely. Lehman began acquiring mortgage lenders directly. In 2003 and 2004, it purchased BNC Mortgage and Aurora Loan Services. The danger with subprime is the variable interest rate after the initial period.
But what does this mean for the total amount?
It means your monthly payment could jump significantly if rates rise. Lehman packaged thousands of these loans together into mortgage-backed securities, then sold them to investors around the world. By 2007, Lehman was the largest underwriter of subprime mortgage-backed securities on Wall Street. The bank held billions of dollars worth of these securities directly on its own balance sheet, not just selling them to others. Lehman also used enormous leverage. By 2007, its leverage ratio was about 31-to-1, meaning $31 in assets for every $1 of actual capital.
That structure meant even a small drop in asset values could wipe out the bank's entire capital cushion.
In 2006, U.S. home prices began to fall for the first time in over a decade. Subprime borrowers, many holding adjustable-rate mortgages, began defaulting in large numbers as their monthly payments increased. The mortgage-backed securities built from those loans started losing value rapidly, and Lehman held a massive amount of them. In August 2007, Lehman shut down BNC Mortgage entirely, cutting 1,200 jobs as the subprime market unraveled.
Despite the warning signs, Lehman did not significantly reduce its exposure to mortgage-backed assets through 2007.
In fact, Lehman continued acquiring commercial real estate at the peak of the market, adding even more risk to its balance reorganization. In March 2008, a separate investment bank, Bear Stearns, collapsed under similar pressure from mortgage losses. In March 2008, a separate investment bank, Bear Stearns, collapsed under similar pressure from mortgage losses. The Federal Reserve arranged for J.P. Morgan Chase to acquire Bear Stearns for just $2 a share, later raised to $10. Bear Stearns' collapse sent a clear warning through Wall Street. Any bank overexposed to mortgage assets could be next. Investors began watching Lehman Brothers closely, since its mortgage exposure closely resembled what had just destroyed Bear Stearns. Lehman's stock price, which had traded above $80 a share in early 2007, fell sharply through the spring of 2008. In June 2008, Lehman reported a quarterly loss of $2.8 billion, its first loss since going public in 1994. The bank raised $6 billion in new capital that same month, attempting to reassure investors it could survive. Bank leadership publicly stated that the institution maintained sufficient capital and liquidity to manage market conditions. Behind closed doors, Lehman executives were searching for a buyer or an outside investor to inject fresh capital. In August 2008, Lehman held talks with the Korea Development Bank about a possible investment or acquisition. Those talks collapsed on September 9, 2008, when the Korean bank walked away from the deal entirely. News of the failed talks became public immediately. Lehman's stock dropped 45% in a single trading day. On September 10, 2008, Lehman reported a third-quarter loss of $3.9 billion, far worse than analysts had expected.
Credit rating agencies began threatening to downgrade Lehman's debt, which would have made borrowing even more expensive for the bank.
As time became critical, Senior government and central bank officials held urgent meetings over the weekend.
On Friday, September 12, 2008, top executives from Wall Street's largest banks gathered at the Federal Reserve Bank of New York.
The goal was to find a private buyer for Lehman Brothers before financial markets opened on Monday morning. Two banks emerged as possible buyers: Barclays from the United Kingdom and Bank of America from the United States. Bank of America walked away from Lehman first, choosing instead to acquire Merrill Lynch, another troubled investment bank, that same weekend. Barclays remained interested, but wanted the U.S. government to guarantee Lehman's most troubled assets before completing any deal. Unlike with Bear Stearns 6 months earlier, the Federal Reserve and Treasury refused to provide a government guarantee this time. Officials later stated concerns about committing additional public funds to support a single financial institution. British regulators also refused to approve the Barclays deal that weekend without a guarantee in place, citing their own legal requirements.
By Sunday evening, September 14, 2008, every potential buyer had walked away from Lehman Brothers. With no buyer and no bailout, Lehman's board authorized the company to file for Chapter 11 bankruptcy protection.
At 1:45 a.m. on September 15, 2008, Lehman Brothers filed the largest bankruptcy petition in United States history.
The filing listed $639 billion in assets and $619 billion in debt. It remains, even decades later, the largest corporate bankruptcy filing ever recorded in the United States.
That same morning, employees at Lehman's headquarters in New York were photographed carrying boxes of belongings out of the building. Those images appeared on news broadcasts and front pages worldwide within hours, becoming the defining symbol of the financial crisis.
More than 25,000 Lehman employees around the world lost their jobs, many with no advance warning at all.
The Dow Jones Industrial Average fell more than 500 points that same day, its largest single-day drop in 7 years at that time. Lehman's collapse immediately threatened other financial institutions that had done business with the bank or held similar mortgage assets. The very next day, September 16, 2008, American International Group, known as AIG, came close to collapsing as well. AIG had insured massive amounts of mortgage-backed securities through complex financial contracts called credit default swaps. With Lehman gone and mortgage assets losing value everywhere, AIG could not cover the claims coming due on those contracts. On September 16, 2008, the Federal Reserve stepped in with an $85 billion emergency loan to prevent AIG's collapse. Regulators feared that if AIG failed too, the damage would spread to nearly every major bank that held its insurance contracts.
Credit markets froze almost overnight. Banks became afraid to lend money to each other, unsure who might be the next Lehman. This freeze in lending, known as a credit crunch, spread quickly from Wall Street into the broader economy.
Businesses across the United States found it suddenly difficult to borrow money for payroll, inventory, or everyday operations. In the days following the collapse of a major investment bank, senior government and central financial officials met with congressional leaders to discuss the situation.
They warned that without immediate government action, the entire U.S. financial system could collapse within days.
On September 19, 2008, the Treasury proposed a $700 billion plan to purchase troubled assets from banks across the country. That proposal became the Troubled Asset Relief Program, known as TARP, passed by Congress on October 3, 2008. TARP allowed the government to inject capital directly into banks considered too important to the economy to be allowed to fail. The phrase "too big to fail" entered common use almost immediately, describing exactly the risk Lehman's collapse had exposed. Stock markets around the world fell sharply in the weeks following Lehman's bankruptcy, from London to Tokyo to Hong Kong. By early October 2008, the Dow Jones Industrial Average had fallen below 9,000 points, down from over 14,000 a year earlier. Unemployment in the United States rose from 6.1% in September 2008 to 7.3% by the end of that year.
By October 2009, unemployment had climbed to 10%, the highest level in the United States since the early 1980s.
Millions of homes went into foreclosure across the country. as the housing market that started the crisis continued to collapse. The International Monetary Fund later estimated that the global financial crisis cost the world economy roughly $2 trillion in lost output.
Barclays, the British bank that had walked away that fatal weekend, returned days later to purchase Lehman's North American operations. On September 22, 2008, Barclays bought Lehman's investment banking and trading divisions for $1.75 billion. Nomura, a Japanese financial firm, separately purchased Lehman's operations across Europe, the Middle East, and Asia.
The Lehman name itself, after 158 years on Wall Street, ceased to exist as an independent company. As the markets continued their freefall, officials convened late into the night. The proposed Stabilization Act represented their last resort to prevent total collapse. Following the financial collapse, company leadership accepted responsibility before lawmakers while maintaining that the full scale of the crisis had not been apparent until it was too late. Investigators later found that Lehman had used an accounting technique internally called Repo 105 to temporarily move debt off its balance sheet. Repo 105 let Lehman classify certain short-term loans as sales, making the bank appear less leveraged than it actually was at quarter's end. A 2010 bankruptcy examiner's report found that Lehman used this technique to move roughly $50 billion off its books just before reporting earnings.
The same examiner's report concluded there was enough evidence to support claims of fraud against several senior Lehman executives.
Before lawmakers, Fold accepted accountability. He did not recognize the extent of the crisis. Events had already spiraled beyond control. Between 2000 and 2007, Fold received approximately $466 million in total compensation.
That figure became a lightning rod for public anger, as ordinary Americans lost homes and jobs in the recession that followed. The crisis that began with Lehman's bankruptcy is now known as the 2008 financial crisis, or the Great Recession.
It became the most severe global economic downturn since the Great Depression of the 1930s.
The crisis prompted U.S. lawmakers to introduce the Dodd-Frank Act in July 2010.
Dodd-Frank created new oversight bodies specifically designed to monitor large financial institutions for the kind of risk that brought down Lehman. It also introduced stricter capital requirements, forcing banks to hold more real capital against their assets, reducing the kind of leverage Lehman had used.
Internationally, regulators introduced the Basel III banking standards, raising capital and liquidity requirements for banks around the world. The phrase systemically important financial institution entered banking regulation, identifying firms whose failure could threaten the entire financial system. Banks classified this way are now required to undergo regular stress tests, simulating severe economic shocks to check their resilience. Lehman's collapse is still used as the central case stud in those stress tests, the benchmark for what regulators are trying to prevent. The decision not to rescue Lehman remains one of the most debated choices in modern financial history.
Some economists argue that letting Lehman fail was a necessary lesson, proving that no bank is automatically guaranteed a bailout. Other Asian economists argue that allowing Lehman to collapse without any safety net triggered far more global damage than a rescue would have caused.
The red line indicates a catastrophic drop by close of day.
We have to inject the capital now, Governor, or the contagion spreads globally.
AIG's rescue ultimately grew to $182 billion in total federal support, far more than what Lehman would have needed that September weekend. That comparison still fuels debate over whether Lehman's failure was a deliberate decision or simply a legal and political accident. What is not debated is the scale of the damage. 25,000 jobs gone in a single filing, in a single building, in a single morning.
A bank that survived the Civil War, 2 world wars, and the Great Depression could not survive its own mortgage portfolio. The crisis reverberated globally. What was once a vibrant trading hub is now eerily quiet as the industry grapples with the aftermath.
Lehman Brothers Holdings spent more than a decade afterward in bankruptcy proceedings, gradually selling off remaining assets to repay creditors. Creditors eventually recovered roughly $65 billion through that process, only a fraction of what the bank had owed when it collapsed. The 158-year-old name that once symbolized Wall Street stability became instead the single word that defined the global financial crisis. Every banking regulation written since 2008 exists, in some form, because of what happened inside that building on September 15.
A single bankruptcy filing, processed in the early hours of one September morning, cost the global economy an estimated $2 trillion.
That is the story of Lehman Brothers. 158 years of history, ended in one weekend nobody could fix in time.